Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome to another edition of the Grain Feed, brought to you by EverAg. This is your weekly news feed for all things grain and all things feed. Each week we bring you updates on the markets with unique perspectives from an amazing team of analysts with the intention of helping dairy and livestock producers manage their risk. I'm your host, Jim Matthews, reporting from Chicago on what has been a really dark and rainy day. The windows are shaking here on the 34th floor. So just throwing that out there. Doesn't happen every day. We're in an old building. We'll throw that out there too. Built in the 1930s. So approaching the century mark on this thing. It's a rainy one. But I tell you what, the big weather problems are down in Kansas, from where Mr. Jake Kingsley, Director of Feed Foundations, is joining us today from Wichita. Jake, how are you today?
We're doing well. A little better than yesterday. We have sunshine and blue skies and some dry weather today. And I think the forecast for the next handful of days looks to be much the same.
Well, that's good. So we borrowed your mayhem up here in the Midwest today. And Jake, we're going to talk about this when we get rolling here. But we look back to our discussion a week ago when we had Kristen Steen on the show with us, and we were talking about WASDE, but we've kind of been talking about your weather down in Kansas over the last week or two, and you've been telling us that it's been getting a little dicey down there, and we're starting to see this reflected in the wheat market and then providing a little bit of support in the corn market. So even though, for the viewers and listeners out there, I do care deeply about Jake and his weather situation down in Wichita, Kansas, I'm sincerely asking because I care, but also we should pay attention to the answers because they directly impact what we're seeing in the market and how it impacts your feed pricing. So there you go. I could just stop recording right there, Jake, but we are going to run through an episode today. So, Paige, if you would please kindly timestamp the broadcast. It is Wednesday afternoon. It's about 3:15 Chicago time. Markets are closed. The screens mostly green on the grain and feed side of things. We did have December corn up 5 1/4 cents at 4.44 even. So we're back above 4.40 on December corn. We even tested 4.45 there for a minute. We have December wheat, Chicago wheat, up 25 1/4 cents at 6.12 1/4. So wheat is back above $6 for December. We're starting to push it for SEP of that 5.90 stretch here, but December back up over $6. Kansas City wheat for Jake, we're looking at December up 24.5, also above $6 at 6.08.5. And then we have December meal, that not as stubborn little byproduct, is down below $300 a ton. We were down 30 cents today at 298.30. And since we're going to chat on it, December bean oil was up just 4 ticks. And when I say just, it's because we've been up many ticks since we recorded last week on Thursday, because we're back above 55 cents per pound at 55.40 for the December bean oil contract. So there's a lot to digest there just based on the settlements of today and comparing where we recorded this thing, Jake, a week ago when Kristen was on. And I guess let's just start with the wheat market. If you take a look at a wheat chart, we have really rallied this thing up from when we were talking about a week ago or so. So if we recorded last week on, let's say, what was that, Jake, Thursday when we were recording, because we were trying to accommodate for the WASDE report, we were trading December Chicago wheat all the way down towards 560. And we were like 562.5 was the low in that session. And then after our conversation that Thursday afternoon, because the market is listening to the grain feed, right after that conversation, when this was aired on Friday, wheat jumped all the way to 582. So a 20-cent jump in wheat, like my floor signals there, 20-cent jump, jumped again yesterday, and a big kid run today of 25 cents, all the way back above $6. So Jake, keep giving us those insights to the world here. What's happening down in Kansas weather-wise over the last couple, let's say, influential sessions here, at least at the board?
Well, I think you probably had to lay a foundation there over a couple weeks ahead of this, which we talked about last week. Was we'd had significant rainfall and we were starting to get to the point to where it may be affecting quality a little bit. Father's Day weekend tends to be the kickoff for wheat harvest in this part of the world. I think there were some folks that got a little bit started, but if you look at the USDA data, harvest is just a splash behind normal pace. And then early Tuesday morning, and probably in many other parts of the state, late Monday night, but early Tuesday morning, at least coming through the central part of the state, we had significant rainfall, an inch or two across a wide swath of the central part of Kansas. We had 70 to 100 mile per hour winds across a handful of counties as a storm moved through here. And then Tuesday afternoon, we had another round of an inch or two of rain across a lot of those same spots with more 60, 70, 80 mile an hour winds and large hail, ping pong ball size hail. So I think that is starting to have an effect on this wheat market and our confidence in being able to harvest that, because additionally, parts of a large swath of Oklahoma caught heavy rains again yesterday and part of today. So there's a big part of hard red wheat country that is now past their normal harvest kickoff and haven't really had any chance to get out there. And the rain that we've had in just the last 24, 48 hours is going to prevent them from doing anything for another handful of days. Probably more importantly is the wind and the hail and what that may have done to crops that were standing out there. That can take a crop from 50, 60 bushels to zero in a hurry. So I think the market's seeing that. That said, we have been having conversations with dairies down in Texas Panhandle and some other parts of hard wheat country that have mentioned that they had pretty darn good yields on stuff that maybe they green chopped for silage or something like that. Now it's obviously a totally different harvest window, but there have been places that have been able to achieve some pretty good yields on some of that. So markets are watching that. I'm sure there's also some geopolitical influence here. You've of course got the Middle East starting to really ramp up. How is Russia going to respond to that? They seem to be pretty heavily involved in conversation there. And of course, you've got the conflict between Russia and Ukraine is a big part of wheat production globally. You've got China also always in these conversations. So you've got big players making big headlines over the last week that certainly has an influence on these markets. We're watching that one. I think the important thing for feed buyers is that this rally in the wheat market is going to start to underpin corn to a healthy degree here, especially if it continues to run as it has. Corn and wheat have a relationship to where at a certain point you can start to plug wheat into the feed rations. As it starts to get bulled up as it has, it's at least going to help reinforce the lows that we retested here recently in corn futures.
And Jake, as we've been talking about corn futures specifically, right, even on last week's call with Kristen and I think a handful of episodes that we've done here, we continue to talk about that 435 support level for December corn. And we've been noting that almost a wedge kind of forming there, right, in terms of there's very much a downtrend formation to an extent. It would feel like a better downtrend channel for the feed buyers out there if we continued to see lower lows. We're definitely seeing lower highs on these recoveries, but we'd like to see those lower lows. And that built-in support at 435, psychological, whatever that may be, it has been holding. If you get something like this, where its fellow grain counterpart, wheat, starts to rally 25 cents a bushel at a time, is it a direct impact on corn? Not necessarily. But you could also assume if weather's been pretty rough for the wheat crop down there, a lot of corn grown in Kansas as well. And so maybe there's a slight concern over some production issues down there. Again, this is very early having that discussion on the corn side, and even bent corn ultimately with a breather and some sunshine is vertical corn, right? So I mean, we're not saying there's been any serious damage down there necessarily, but there's a few impacts floating around that will at least limit the downside potential on corn, and as you said, Jake, at least provide maybe some upside. And to throw in another support factor, yeah, you have the Middle East situation as well as the Black Sea, which can intertwine here as well. There's a lot of chatter on what's happening with shipping lanes out there. It's been primarily from an energy standpoint in terms of those discussions. But if you start to jam up enough shipping corridors, it's not just an energy conversation. It is a food and feed conversation, and particularly wheat in that area of the world. So we have to kind of watch each of these and how they're impacting the grain markets. And then also, I think on last week's call, and we just keep referencing it because it was a good one and very relevant to what we're discussing now, is that we started to allude to maybe what the bean oil and meal situation would look like if we were able to pass this budget bill and have certain tax credits or incentives involved. Then we started talking about some of the renewable obligations that would be coming from the EPA. And sure enough, on Friday, they gave some to us, and bean oil has just been on a tear since last week as well, Jake. So what happened with bean oil to spark this rally all the way to 55 cents a pound lately?
Well, and we've been talking about this for a lot longer than a few weeks, but this expansion in soy crush capacity over the last handful of years has been driven by growth in demand for renewable diesel, where we effectively take soy oil and other veg oils and are able to process them in a way that they are chemically identical to diesel fuel. And the government has run with that and started to create these incentive packages and blending mandates to bring that online in a bigger way and implement it into the fuel system here domestically. And so finally on Friday, we got our second draft of the proposed blend volumes that will be required of all different renewable fuels over the course of 2026 and 2027. There had been some questions around it back just a month ago or so. There was actually some concern when the government kicked the can down the road as far as making a decision there that they may come in and reduce the blending requirements from what initially been expected. Well, Friday, they finally came out with some numbers. And again, this is a second draft of proposed requirements that won't be officially signed off on until it sounds like December at the soonest. But they came back with a 5.61 billion gallon blend requirement for renewable diesel, which is up about 65% over what we're doing this year in 2025. And then there's another increase on top of that when we get to 2027. That is just a fraction under what the market had initially anticipated early this year, and a pretty big jump over what we were concerned was going to be the cutback a month and a half ago. And so soybean oil now having a place to go, a nice healthy demand center, or at least a lot more confidence that it will be there, jumped 15% over Friday and Monday's trading sessions. And so that's good for a feed buyer because now soy oil is once again the primary revenue generator for these crush plants and should put some pressure on soybean meal and soy hulls and canola meal and all the things that come out of those crush plants. Now, the interesting part of that is that soybean meal futures really only went down and broke through their old low by about $2 a ton when it was all said and done, against a 15% rally in 2 days on soy oil. So basis hasn't really had enough time to respond to this, I don't think. I think there's still room to put pressure on both futures and basis for soybean meal and canola and all those other bypass proteins. There's plenty of time, but it feels like the way that the feed ingredients have traded over the last few days, they still want to see this bean crop realized. They want to see these proposed blend requirements pushed through in black and white ink, that they will be what we think they are come time to actually start that processing. So the market is back towards the low end of where we've traded. Good opportunity to step in and own some of these feed ingredients. I think there will be more room to the downside and you can manage your risk accordingly now for that. But for the moment, it's kind of steady. So interesting little play there, but I think it gives us good confidence for the future.
Very interesting discussion. I had the privilege of speaking to the National Futures Association here in Chicago yesterday. So shout out to the NFA. Thanks for having me over there. And I showed one of the bean oil charts and had to explain this gap of of what we traded between Friday into Monday, of running from, let's say, 51-ish cents a pound into the 52s, 3s, and what ultimately got to the 5s, with a couple limit up days in a row, which you do not often see at the board lately. And then, yeah, there's been a little bit of, it's not even really consolidation, just kind of maybe stalling out at what has been an aggressive move higher. So yeah, today and yesterday we didn't do a whole lot on bean oil. But you have this fascinating element of explaining what bean oil is doing on its own. But as you noted, Jake, one would think, in terms of the relationship between oil and meal and why we have been crushing beans now for several years, the focus has been on the oil side, the renewable side. You'd think if we ramped up bean oil demand and saw futures move the way they did, you'd think meal would collapse, right? You think it would just say, hey, we're going to continue to supply the globe, supply the US with this protein, and prices are just going to nosedive. They broke $300 a ton, which, as we discussed this stubborn little byproduct, that's been the stubborn support level, if you will. But like you said, Jake, it wasn't by much. And to have bean oil run the way it did, for meal just to kind of pull back and just ease under $300 a ton, it's not exactly what I would have been hoping for in terms of gauging this downside potential. So that being said, maybe the market's telling us to take advantage of owning this protein while we can, or at least hedging this thing while we can for new crop as prices sit where they are on the meal side of things. So really interesting stuff. It's always difficult to maybe trade based on proposals or drafts that we see, but that's what you get when we're dealing with the futures markets. So, okay, Jake, always interesting, not just Kansas weather-wise. There's a lot of interesting things happening in the grain and feed markets. So, Jake, a huge thanks. Thank you for being a part of the show. And Jake, stay safe out there.
I will try to. I think we're supposed to be in pretty good shape for a while, so might be easy for us.
Okay, because I do sincerely care. And that's on record. I just want that on record too. We'd also like to thank the Everac Insights crew for their support, and thank you to Paige for production magic, and thank you to the viewers for watching the Grain Feed. Contact information is on the screen. We greatly appreciate your feedback. That's all for today. We'll see you next time on the Grain Feed.